Now let's kick this thing off. Darius Dale is the founder and CEO of 42 Macro, the leading macro risk management advisor. In this conversation, we talk about what's going on in the macro economy, what's happening in the financial markets, how Darius is looking at various metrics, and also what you at home should be thinking about as you invest your capital. I really enjoyed this conversation with Darius, and I hope you do as well. Before we get into this episode, though, I want to quickly talk about our sponsors. Today's episode is brought to you by Pipe. Crypto is all about giving the power back to the people, and our sponsor, Pipe, is doing that in a big way. Pipe is the world's first trading platform that allows you to trade recurring revenue streams for upfront capital. And with Pipe's new API, companies with recurring revenue can build seamless, embedded financing options into their platforms. One of the most interesting uses for Pipe's new API right now is Compass Mining's Mine Now, Pay Later, which powers payment plans on Bitcoin mining hardware so more miners can start or scale with a smaller upfront investment. Whether you're looking for mining hardware or scaling any business with recurring revenue, check out Pipe to access growth capital with no loans, no dilution, no restrictive covenants or warrants, just growth on your terms. And right now, Pomp Podcast listeners can access tens of thousands of dollars, even millions, fee-free for 12 months. Whether you are a Bitcoin mining company looking to enable financing for your customers, or a SaaS, DTC, or any business that has recurring revenue, sign up at pipe.com/pomp. Again, pipe.com/pomp to start trading today. Today's episode is brought to you by Exodus, the world's leading desktop, mobile, and hardware crypto wallet. They offer beautiful, user-friendly blockchain products that sync across all of your devices, making it easier to send, receive, and exchange over 150 or more crypto assets in one place. And with world-class customer service available to you 24/7, Exodus always has your back. But the fun doesn't stop with staking and trading. They recently launched a new Nft Marketplace where you can buy and sell your favorite NFTs on the Solana network. By partnering with the popular NFT platform Magic Eden, they're offering the full Monty on verified collections, with more added every single day. Ready to check it out for yourself? Run, don't walk. Over to exodus.com/pomp for your free download today. Again, if you want the world's leading desktop, mobile, and hardware crypto wallet, go to exodus.com/pomp today. Today's episode is sponsored by Abra. They're based in California, and they're backed by top VC firms. Abra is an all-in-one, simple, secure app that allows you to trade over 110 cryptocurrencies. Get 0% interest loans using your crypto as collateral, and earn interest with up to 13% APY on stablecoins and 7.15% APY on Bitcoin. You can join nearly 2 million users by downloading Abra from the Google Play or Apple App Store. If you download the app today, you will get $15 in free crypto once you fund your account. You came, you invested, now conquer. Abra, conquer crypto. Go check it out today. All right, let's get in this episode. I hope you guys enjoyed this one.
Anthony Pompliano runs Pomp Investments. All views of him and the guests on his podcast are solely their opinions and do not reflect the opinions of Pomp Investments. You should not treat any opinion expressed by Pomp or his guests as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his personal opinion. This podcast is for informational purposes only.
Yeah, they don't have
Wait, say it again?
Are they allowed to like or dislike things the government does in China?
Are they allowed
just,
to, or
just put your nod your head and keep moving?
Nah, I think that, by the way, Darius is here.
I'm always here, by the way. You just don't see me.
In case anyone didn't know, Darius is here.
They just move the TV out of the way.
One of the big things that I think people don't really understand about the whole China thing is you may not know. I'm not an expert. Let me first just throw that out there. I'm not an expert on this, but there's these octopus cards, which allow you access to the kind of public transportation, whatever. And these octopus cards during the Hong Kong protest, all of a sudden, they started to be used as a surveillance tool because what they were saying is, why did you get on the train at that station and then get off at the one right next to the protest? 100%. You must have been going to the protest. We're going to come after you. We're going to do something with the social credit system, like all these issues. Totally. So I remember during that protest, there was incredible lines because what people were doing is they were going into the machines, they were getting cash. And then they were using that to pay so that they didn't have to use the card that couldn't be traced, right? Untraceable payments. And you start thinking about this stuff and it's like, okay, that sounds kind of crazy. Like that only happens in an authoritarian government situation. Wait, Canada just did the same shit. If you went to the protest and you participated, then they were freezing your bank accounts. They were, coming after you with financial sanctions, all this stuff. And so, like, in the world, I don't think a lot of people are like, oh, China and Canada, those are run by similar people. In almost every conversation, you'd be like, those are very different. The similarity, though, is your actions tied to your financial transactions became a target for the government. Now, take it a step further, which people don't like when I say it, but if you just happen to win the ovarian lottery and be born in Russia, you kicked out. Right? Just because you literally were born on a piece of land with an imaginary line around it and a flag that everyone sits and looks at in the classroom.
Yeah, totally.
And so you start to look at it. Now, again, there's more complexity to it than just that. But again, where you were born ends up putting you in a situation. If you participate in a protest, if you use a specific type of transaction, like all that stuff ends up being like, damn, we're heading in a direction like that don't sound good.
What's the bull case for all this? Like, you guys obviously talk to a lot of people a lot more about these topics than I do. Is there someone in support of these ideas?
Oh, yeah. If you wear a suit and tie, got a cologne and a fake Rolex, and you walk into the Washington, D.C. office, you love this shit. Right? True. Think about this. I get to now send money cheaper. Right. Yeah. I don't have Leon Cooperman or Ken Langone going on CNBC being like, I'm a billionaire. Why did I get a $1,200 stimulus check? Well, it's because you didn't show that you actually made $1 billion last year.
Yeah,
you had losses. Yeah. So like that you end up getting hopefully easier to get money in the hands of people in times of emergency, like all that type of stuff. Second is I think you have a whole argument around the rails are better. So if I can drop the cost for people to actually use this stuff, there'd be more transactions, more velocity of money. It ends up being better for the average person, whatever. And then the third thing is I think that there is a desire to be seen as innovative. Mm-hmm. So not actually be innovative. It's like, oh, everyone else is going to do it. We have to be early because we're innovative.
I think that's what it is, too.
But it doesn't change the monetary policy. Like, there's still going to be 8% inflation, whether it's a physical dollar or an electronic QSIP or a digital token. It's still 8% because y'all print
monetary policy way worse. This is how monetary policy currently is what works. Fed tells market participants that they're going to do something. Market participants price that into money markets and interest rates and all across the sovereign debt curves and particularly money markets. And then the rest of the financial markets price off of that. At least there's smart people in that sort of chain of command that are, taking risk and, have capital allocation and real consequences for making poor investment decisions. If you just allow it to just go back to the entire monetary policy, back to that, round table in the Eccles building, then to me, that's a significantly worse outcome than where we are today, which is a completely unmitigated disaster.
So I'm going to take it one step further. There's three things that are like real scary stuff. Monetary policy right now, 12 people, FOMC, they go into a little conference room. They get horrible data fed to them by all of their consultants and their staff. They do the best they can with bad data, and they come out and they usually make decisions that short-term mitigation of pain, long-term consequences, and that's the way that this works.
It's called smoothing, by the way.
Correct. When you think about that, when they make that decision, and literally Jerome Powell, whoever the chairman of the Federal Reserve is, they stand up at the conference, press conference, and people are trying to guess what's he going to do, raise rates, not raise rates, whatever. That is a one-size-fits-all monetary policy. Yeah. So you, me, them, everybody else in the country and around the world that hold dollars, all are subject to the same monetary policy.
Exactly.
Well, when they digitize this, now you get a different monetary policy than I get. So in the most positive light as you could possibly have, oh, you're in a dire financial position. What we're going to do is we're going to give you a lower inflation level. We're going to give you cheaper access to capital because you're going to get a personalized interest rate versus somebody who is wealthy or in a good financial position. Maybe we will smooth it by giving them higher inflation or giving them a higher cost of capital. And so you start to play this game of personalized monetary policy. Everything else in your life is personalized. Your music playlist, your search results, literally the maps when you go and use Google Maps.
Yeah.
Your monetary policy is going to get personalized as well. Now, the negative, worst, nastiest view of it, Darius, you ate too much McDonald's this week. Joe, your ass ate too much candy. And John, you've been eating healthy. So guess what? Joe and Darius, you guys, we're going to jack your inflation level up. We're going to give you the highest cost of capital because you're doing things that are negative towards society. You're leading to obesity, blah, 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 all this stuff. John, you're amazing. We're going to drop everything for you and make it the most attractive monetary environment
Well, they could
possible.
even bar you from going to those places, right? Or
We haven't even got there yet.
Yeah.
We're just talking about the monetary policy.
Wow. Yeah.
Don't even think about going there.
So that's problem number one. It's personalized monetary policy.
Yeah.
Second thing, expiration of money. So China's already testing this. We have this in the United States already. EBT cards, they give it to you. They tell you what you can spend it on. Has to be unprepared food, not prepared food, things like that. Yep. Most people don't know this, but if you get an EBT card and you save, so you don't spend all, let's say it's $500. 12 months later, if you have not spent the money from that first card, it disappears.
Yep.
So you have a 12-month window. Now, 12 months, most people are like, okay, 12 months, like not the craziest thing in the world, whatever. Well, if I give you the CBDC, I now can make the money expire on a certain time frame. Yeah. So in China, we're going to give stimulus. The point of giving the stimulus is for you to go spend it, not for you to go and save it. And so you have 2 weeks to spend the money. Imagine if during the pandemic they said, okay, $1,200 checks, everyone gets it. You have 2 weeks to spend the money. If you don't spend it, it expires.
Yeah. Everyone would spend it.
Can't save it, can't invest it, can't do any of that.
No, it's just there's rails. You got to spend it on the things we told you to. If you don't, it's done. Like you get in a weird, crazy world. And then lastly, third point is just no. Like it just CBDC declined. You cannot go to the movies. Or yo fat ass got to walk.
To walk to McDonald's.
Because you've been eating too much food. What, you know what I mean? Like you can get like really, really egregious with it. Like that's the stuff that like I don't trust that these people are not going to go there in those situations.
But in a weird world, this drives much more people towards Bitcoin, right? So don't you agree, right? Doesn't this ultimately set them up for failure when it comes to people leaving, whether it's the digital currency, the US dollar, whatever it is, but going towards a solution like Bitcoin?
I don't know. What do you think?
100% it does. I mean, what's the alternative? I mean, if you have a government, an entity that could just take away all your life savings, I mean, obviously they wouldn't do that. You certainly wouldn't expect a country like the U.S. to do that or be able to even pass laws that can get you to that point. But let's take this, we got to go to the extremes to really make points here. If, you had an economy like that, that's very similar to like what you experience in third world countries with, physical goods confiscation, obviously banks closing and things of that nature. So, yeah, definitely. I mean, it's the bull case for digital assets is becoming very clear by the day. And so, if you're not, to me, it's like it's a no brainer. But when you make these commentaries, and I've used to be in the camp that central bank digital currency was actually a good thing because for all the reasons you just described in terms of being able to enact more thoughtful monetary policy. Right now, it's a complete shit show. But in the reality is, it's not just monetary policy. It's all kinds of, what it really does is expand the scope of policy, the big P word. That's all it really does.
Which, as you can see from that standpoint, we're going to have more tools. If we have more tools, we can better address, we can better intervene in the market, we can better do all. So like the pro argument sounds amazing, but it's kind of like the MMT stuff, right? It's like, wait, I get free money? Like, yeah, sure. Yeah. Politicians, how do I get elected? Like, I'm going to give you free money. Everyone's like, yeah. It's kind of like in high school when the student government, thing gets done. What does the winner always do? They hand out candy. Always. They bribe you.
Exactly.
Right? Like that is what politicians are starting to do. Is like, we're going to give you $1 trillion here, $1 trillion there. I saw a clip recently. Somebody had one of the White House spokespeople talking, and they were like, we need, there's a bill or something with asking for more money. And a reporter was like, you had trillions from COVID relief. Where'd it go? Like, you guys are out of money. You need more money now?
More money? Yeah.
And then wouldn't answer. He asked again. He's like, but where did the trillions go?
If he was smart, he'd be like, we gave it to you.
And so, people got all upset, whatever. But I think that's part of this is you then get the surveillance stuff, right? Which is, I don't know.
Darius, how would countries around the world perceive the U.S. if we issued a CBDC?
I think the Western societies would definitely follow our lead on that. There's just sort of, I want to call there's someone smarter than me, hedge fund manager. I'm blanking on the name, but they kind of created this persona, the Davos man, the global man, the institutional person, that person. And I think, pretty much every central banker in Western society is very connected to that community. They're in that part of that community. They're a very key part of that community. And so if we adopted a central bank digital currency, it'll be cheered, it'll be celebrated, it'll be, further adopted by all the Western nations. And for an extended period of time, it'll be a great thing. right? Like the benefits will come sooner than the costs. And that's kind of the issue with a lot of these types of things, which is, we give you free money, we give you all this stuff, but guess what? A year and a half later, we have the worst inflation we've seen in 40 years, and everybody's out there hurting and struggling. And oh, by the way, all that free money's gone. And it's getting eaten alive by inflation, by rental increases, by food cost increases, by transportation cost increases. So I think it'll be very similar to that, which is, this is great. Oh no, wait, it's not great. Oh no, wait, it's getting worse. How do we get? What's the out? So the only way I think they could probably do this well, and what I mean by well is something that's acceptable to the 4 or 5 guys in this room, which is you'd have to sort of I think you'd have to amend the Constitution to account for the potential overreach of government into society as a function of being able to sort of regulate the big P at a more kind of
this is why a lot of these politicians, there's Emmer, there's Lummis, Cruz, a bunch of them. I'm going to not be able to name all of them, but a bunch of them want to either prevent the Federal Reserve from doing this and issuing it directly to the individuals, or what they want is they want a guarantee that it'll be permissionless and basically preserve all the aspects of cash around the privacy, et cetera.
Yeah.
And hard to see a path how we get there. We should. Right.
There's no chance. Why would a central bank go through all the problems of issuing a digital currency if they don't get all the goodies?
Yes.
That's like, no, it doesn't make any sense.
It's pretty crazy. We've got a chart from you that you sent over, the Bitcoin and Ethereum.
Yeah, finally broke out to bullish. We were talking about that last week.
Let's get into it, baby.
Finally broke out to bullish.
What are you seeing?
I told you we had a window of opportunity here. We still, like I said, we have this window of opportunity between now and let's call it May or June, where the economy is still hanging in there, and growth's not decelerating fast enough to catalyze like a breakdown in risk asset prices. And in the context of this window, the next chart actually, because the Bitcoin Ethereum chart's pretty obvious. The next chart, which I show the financial conditions, and actually viral tweet yesterday, which I think is pretty funny, which came from a hilarious conversation I had with my good friends over the weekend, which is we still are like, we're all talking about tighter policy and quantitative tightening and rate hikes and stuff. But the reality is the Fed's only done one rate hike. The Fed's balance sheet is still, $8-9 trillion. And guess what? As a function of those two things, we still have booty models on TikTok giving financial advice. And then so that what the red line in that chart shows is the Goldman Sachs Financial Conditions Index. So it's like the VIX. So when the financial conditions are really loose, the price of the red line is low. When the financial conditions are tight, it's like the VIX, goes up when things are getting worse. Financial conditions are tightening. Right now, today, we are as loose from a financial conditions perspective as we were, or more loose rather, than we were at the peak of the tech bubble, the dot-com bubble. The peak of the dot-com, we are more loose today.
That is wild.
That is wild. Like imagine back in 2000, I mean, we wouldn't have had TikTok, but you would have had Wall Street Journal ads with booty models pitching tech stocks. So that's exactly where we were. We didn't even have that back then. So this is I'm kind of making a joke with the booty models, but it's it is what it's a microcosm of where we are today in society, where we are today in policy. And so until we really start to drain that liquidity, hike rates at a more expeditious pace, it's very unlikely that we see, new lows and things like crypto and digital assets. In fact, it's probably likely that we could, see some highs here. But will we get back to the prior all-time highs? Put a gun to my head, I'd probably say no. I don't think the window of time is long enough for that. But I certainly think...
just relative to how fast we start hiking rates aggressively?
Yeah, this is a 1 to 2 month window at best. It could be shorter depending on what happens with Russia and Ukraine.
And you don't think that there's an opportunity for them to continue to increase in price in the face of that?
So there's two countervailing forces, right? There's the holy crap, this whole thing is everything. The long-term secular bull case for Bitcoin it's all happening right now. Everything Satoshi's been saying since day one, and every Bitcoin bull who's been accumulated over the last decade plus is now seeing the bull case play out in real time. And it's a lot easier to sell it to somebody else who has not participated in the asset class. So there's that fundamental flow. On the other side of it, you still have a decent amount of people who bought Bitcoin and either institutional or people who have overly allocated to other risk assets and are feeling pain. So it's you have these two massive forces. My man Jim Carson has been using this word. I think it's a perfect word to describe what's happening in financial markets and in the economy this year, which is leptocurtic. you have these sort of massive fat tail distributions. You have these big forces on either sides of the tails that are really, bumping up against each other. And, we had a big, kind of slip down in asset prices when the Fed sort of started to signal that they were going to reprice monetary policy in January. Then we had another slip down in February with the Russian invasion of Ukraine. Then we had a massive slip up as a function of, we didn't fall off a cliff from growth terms. We didn't go to World War III. And so you're having all this massive two-way volatility. And so I think that's what's likely. That's what's been happening in crypto markets really since they bottomed in late January. And it could continue to happen, but I just think the window of time for now is positive enough for the bull case to win for a little bit.
And how do you think about it when it comes to institutions versus retail, right? Because if we get into a recession, obviously retail, they need money, they need to access that capital, right? They can't last they can't hold it, right? But institutions potentially could, even in the face of rising rates or whatever it is, depending on kind of what catalyst we see. If we see a positive catalyst, are they able to stay in there and be able to see the price raise, or institutions, are they going to drop out also, you think?
No, see, the problem with most institutions, so any legitimate hedge fund has, generally strict risk parameters.
Yep.
Like you can't even really be a hedge fund these days without having very strict risk parameters, and most risk systems or volatility is kind of the central component of risk. A measurement of risk, VAR, is kind of the most popular. Value at risk is the most popular framework, but there's other frameworks. I know Citadel uses a different framework. If we got into anything that looked like a recession, or more importantly, it's not even the recession, because generally speaking, risk assets bottom in recession. It's the path to recession. It's going from economy slowing to, oh no, wait, this could be a recession. That's the window where you get the most pain. And so on that path, it's very unlikely that an institution will be able to maintain the same size exposure to a high beta risk asset, because at the bare minimum, other high beta risk assets are going down in price. And from a correlation perspective, that correlation is going to drag down Bitcoin and other assets. And even if it's uncorrelated, just the sheer fact that you got to take down risk broadly means you got to sell everything systematically just to reduce the size of your portfolio.
And you don't think we're on that path? Like in my mind, right? It's pretty clear that we're probably on the path towards a recession, right? Yeah. But we haven't seen. I mean, we've seen some sell off, right? But we haven't seen total destruction bottoming out that you would imagine, right?
Exactly. And this is the great question. So that to me is like trying to add some calendar to this, because to me that's the name of the game in institutional finance, is understanding like the actual catalyst and when things should happen, so you can actually hedge appropriately in both directions. We are not going to be going. Remember I said that we had the window where it's like, okay, growth slowing, we're below trend, and if we keep slowing, recessions, it's going to go from a 50% probability something higher than 50. That to me, that window is probably Q1 of next year.
Okay.
How's this change if you got guys like Do Kwon in the market buying billions of dollars of Bitcoin? Like how much of the macro gets overridden by market structure and the individual asset versus it flips? And like it doesn't matter what's happening in the market, it's the macro.
Depends on what window you're in. Right now, we're in a window where that could overwhelm prices to the upside. Mm-hmm. I think if we were in Q1 of next year, it would get overwhelmed by everybody else selling. And so to me, the markets have choices, right? So that's where I think the economy is likely to be. I'm speaking to the U.S. economy here. Europe's probably a quarter behind. That's where the economy is likely to be in that particular time frame. So asset markets can price that in sooner or later. It's never. You're typically never more than 1 to 2, at most 3 months ahead of those types of catalysts. So let's call it Q4 of this year. You're probably likely to see enough pain to really spook investors, both institutionally and retail, to kind of demand liquidity. And more importantly, I think what's most likely to happen is that demand for liquidity is going to spook the Fed out of tightening us into a recession. Like the Fed, we still have time to avoid the recession if the Fed doesn't do what it's already told us it's going to do. The problem is if they just do what they're going to tell us to do, they're going to be doing it for way too long. And by the time we get into the first part of next year, it'll be too late.
So I want to switch gears for a second.
For sure, let's do it.
We've been talking about Bitcoin and crypto. I'm going to throw a curveball and just get your thoughts.
Let's go.
Because I just saw this recently. Mm-hmm.
I can't hit a curveball for shit. Don't even look at me.
The new home sale price in the United States is up 25% over the last year. And it just today crossed and hit $511,000.
Median.
Like 2 weeks ago, it was a big deal because it crossed $500,000.
Yeah.
It's $11,000 increase in a matter of weeks.
Yeah.
What the fuck is going on?
There's a lot of things going on in the housing market, but one, there's obviously not enough supply. For whatever reason, I can't tell you why, but but it's very probably for the same reasons that the energy the E&Ps, the energy producers, won't drill. They just refuse to respond to supply, and maybe they're saying, maybe it's a tacit admission that they themselves don't believe in the sustainability of prices. Now, generally speaking, you don't tend to have, and this is a very famous last words, you don't tend to have nationwide declines in home prices, which I think is what Bernanke said right before the financial crisis. So I'm borrowing a quote for him. So it's a little bit, the lending standards, in today's housing bubble are extremely different than they were back in 2003, 2004, 2005. And so, you certainly lending standards and products, adjustable rate mortgages, all that kind of stuff, no income verification loans. We don't have that stuff now. So the probability that we have a housing burst for this bubble is low. But what is likely to happen is you're just going to price people out of the market if you haven't already. And eventually you're just going to have a lot of inventory that does not move, and home builders are not responding to the demand fast enough. So what's that going to do? It's going to create a massive sort of secondary wave that we're already experiencing, that we're in the early innings of in terms of rental inflation.
Is it fair to say that this is a better measurement of inflation than the CPI?
No. I mean, so neither is a perfectly good measurement of inflation, right? Okay. I mean, inflation is personal.
Which one's closer, 8% or 25?
No, CPI, because at least CPI is a broader basket, right? It's assuming. So which one's closer to
33% of it is shelter?
Let me answer this appropriately. That's a good question. So housing price inflation today is probably more reflective of where the level of price changes in the economy than CPI. But CPI generally is a better basket to represent price changes in the economy.
Okay, so over the long term, CPI is better. Right now, housing.
Right now, you especially down here. I mean,
that's a good answer.
Yeah, especially down here. I mean, it feels like there's 50% inflation down here.
Crema. They just jacked up
again.
Another quarter is $5.25 now for a large iced coffee.
It's outrageous.
When we moved here, it was like $3.75.
Yeah,
how's that happen?
How much is it now?
I can't afford my pastries, man. This is getting ridiculous.
Yeah, I mean, look. By the way, like I'll pay them $6 if they want for the iced coffee. It's like putting crema. Some people are like, I'm gonna complain about the gasoline that I gotta put in my car.
You're about to get personalized
the price just went
up. We don't need CBDCs for him.
Pops here, $10 iced coffee. Like shit, okay. Need my gasoline to get going.
Yeah, and that's the issue with inflation, right? It's like it's personalized. Everyone in this room can afford a $6 or $10 iced coffee. Although I'd probably stop myself out
at $10. I'm over. Like
I don't need coffee.
$9. I'm grabbing some tap water on my way.
I'll just eat the coffee beans. I'll just buy.
Pull the hose out from the building.
I'm good.
I'll need that.
If you get to $9.99, you got me. You cross the 10 just on principle alone. I'm out.
Joe and John like grinding coffee beans.
But I do think this idea of like, how do you measure inflation right now? And it's like, okay, I'm not going to go as far as to say I believe inflation right now is 25% in America, but I sure as hell don't think it's 8%. I think it's double digits. Is it 12% or 20%?
Well, I told you it is. It's already double digits. It's definitely 10% minimally.
But that's what I'm saying. So like when you start to look at how to measure it, we're in the teens at least.
So how we measure it, at least throughout the pandemic, because there's been so much variance with respect to the COVID waves, it's been difficult to measure things on a year-over-year basis, or not difficult. It's been stupid. It's not a true representation of what's happening. So we've been measuring all most hard economic statistics on a month-on-month or 3-month annualized percentage change basis, which is similar to year-over-year, but just looking at it month-on-month or 3-month on 3-month. Inflation on a month-on-month annualized basis, headline is 10% already. So we are having double-digit inflation. It just hasn't caught up to the year-over-year. It will catch up to the year-over-year statistics. Will catch up to the annualized momentum. That's what happens in the time series. And so, we do have double-digit inflation in this country, and it's probably being underreported, if we're being honest.
The March inflation report.
Oh, where were we? I was at 8.5.
8.5. You coming out on sticking with that?
Tuesday, April 12th. Yep. And this is before Bloomberg Consensus hasn't even put out their forecast yet. I think they'll do that tomorrow.
You think 8.5?
8.5. Got 8.5 on its way to 10.
What did I say? 8.3?
I don't remember.
It was just below you, I think.
We'll go to the tape.
Yeah. But I may go up now.
No. Here's why you should go up.
I actually. You think you should go up?
I think 9's probably closer to the reality after seeing the European inflation data. So in the last 2 days, we got Spanish, German, French, and Italian preliminary March CPI data. They were all pretty high. So Spanish was like 9.8, German was 7.6, France 5.1, and Italy 7%. All but Italy, like Germany was like 100 basis points north of the estimate. Spain was over 100 basis points north of the estimate. France was like 30 or 40 basis points north of the estimate.
How much of that is because of energy, given that they're so dependent on Russian energy and natural gas versus the U.S. has some differences? Or do you think it's pretty much across the board?
No, it's going to be across the board. We're going to feel the same energy price shock as they felt. And so the point I'm making is that inflation, the reported data blew the expectations out of the water, even though everybody on earth knew we were going to have a big surge in inflation in March, and the economists still were too low on it. And so I think the probability that we get
a 10 print
was,
I don't think so, but it could.
How much do you think the inflation this month will be affected by, hey, we've seen price raises over the last year, so you can't raise that much year over year on a percent basis?
Yeah.
The compounding effect.
Yeah.
Yeah, so
last year inflation wasn't that high.
Well, we didn't get it until a couple more months, right?
I think it was like June was when we started getting into fives.
March, yeah. So April, the April data was where the sequential momentum really accelerated, and so April will be the first month where base effects really kick in. But again, that's a moot point. I think economists are being disingenuous right now. We keep talking, economists, particularly at the Fed, continue to say base effects are going to, base effects are going to bring down inflation, base effects are going to bring down inflation. And that's true. That's accurate. But the problem isn't the level of year over year inflation. The problem is the fact that inflation continues to accelerate. Price increases continue to go higher.
Yeah,
so eventually when those base effects wear off, you're still going to be at like 10%.
Well, your point is like if you grow 5% year over year and then you grow 4% the year over year from that, you shouldn't celebrate. You should be like, why the hell is it still going up 4% after we went up 5% the year before
Bingo.
That? Yeah.
And we're not even, so what you just said is accurate. And what I'm saying is what's actually happening is we grew 5% year over year and we are now growing 6 sequentially. So the expectation that we're going to 4 next year is ridiculous. We're actually on our way to 6, not using those particular numbers.
Do you think we hit 10% at all in the United States?
So again, we are at 10% sequentially. Will we get to 10% year over year? We only have 1 month to do it because by the time we get to April, the year over year numbers are going to start to come down. And so that's a problem for...
You sound pessimistic. I mean,
it'd be a big jump from 8 to 10, right?
Yeah, so if it happens, it has to happen in March is what I'm saying. The probability that it happens in April is much lower because the base effects accelerate so quickly in April. So that's I don't know. Again, we're a long ways away from anything that get the Fed off of what it's doing, which means we're a long ways away from getting back to a more positive market dynamic.
I think it's 50-50. We hit 10%.
Ooh, okay.
I don't know.
If this was a sports book, that would not be the odds.
Yeah. No.
The over-unders on 9.
I'm going to caveat though, which is the 50-50 breakdown is I don't think it hits it in March. I think we probably come. I do think that there's a higher probability of breaking 9 than most people are assigning to it. It's like 9.1, 9.2. Somewhere
after this data, I would agree.
Yeah. So 10. The only reason why I probably put higher odds on it is I'm not convinced that fertilizers, natural gas, oil, like all those issues, like I think people are like, oh, it peaked. There's not gonna be any more problems, right? Or like we saw the worst of it. But like, I don't think we quite understand if fertilizer prices really do spike how it looks like they are. It looks like we're not going to get a lot of the Ukraine and Russia wheat out of there.
Yeah.
And so you start to add this complexity, like there's just too much global chaos. And what I'm assigning more probability to than I think other people is that the Fed and politicians don't know how to solve these problems from a first principle standpoint. The only thing they know how to do is spend money. And so if gasoline prices stay above $5, $6 in the United States, they're going to hand out gas cards. If food all of a sudden becomes a huge issue, they're going to start to do all sorts of things that create more inflation.
100%. So stupid.
And so if you do that, even though there's the base effect, there's a shot. Again, I say 50-50 because I don't know, but it's just like there's a structural thing underway, which their response, unfortunately, is going to be step in, spend, gas cards, like all this shit. And like just how inflationary, I don't know, but they spent trillions.
Yeah.
And we got to 8% so far. Like the next bill, what are they going to do? 5 trillion, 7 trillion. Like these guys are just going to go bigger and bigger and bigger.
So I'll push back on that a little bit because I agree with that's where we're going, but the process to getting there is non-linear because you need 60 votes in the Senate to change tax and spending law. And so obviously, Democrats have the narrowest majority ever in the House and Senate, 50-50 with Kamala Harris being the tying vote. They're not going to be able to change tax and spending law, particularly ahead of a midterm election. The Republicans aren't going to go for that. Republicans aren't going to do anything that makes the Democrats, helps the Democrats.
You're assuming that there's a difference between those two parties.
There's a difference heading into a midterm election, but there's not a difference in terms of their policies. By the way, I've been saying that for years.
True.
I'm going to go on a rant right now. I've said this for years, going back to 2017, Tax Cuts and Jobs Act. When I saw that legislation, I said, wow, so it looks like the Republican Party prefers blowing holes in a deficit this way. The Democrat Party prefers blowing holes in a deficit that way.
Correct.
But it looks like both parties love blowing holes in the deficit. There's no difference between two parties fiscally anymore. There was when I first started in Wall Street. Paul Ryan and Ron Paul, those guys, there was a real faction that the Tea Party was legitimate. There was no more Tea Party. Yeah. There's just blow hole with tax cuts, blow hole with spending. But guess what? You're just digging a deeper and deeper hole. So rant over.
No, but I think that this is the whole thing is there's more of an appetite now to spend tax cut, like the whole thing. And I don't see a world where regardless of what the Fed does, the Fed is not just fighting inflation. The Fed is fighting politicians.
Yeah.
And the politician, I mean, we've already seen it. They did a press conference yesterday. They're
AOC.
like, we need more money. And the guy's like, what do you mean? You had trillions. Where'd it go?
Did you see AOC's comments about price controls?
No.
Oh my God. This is like, where do you get these people from? Like, just pick up a book and read 2 pages of a book about how bad price controls are.
What did she say just generally?
Well, she was just like this is where we got to go. We got to do something about inflation. So price controls is the next step.
You know what's funny about that? Yeah. On December 29th of 2021, I wrote a piece that said price gouging, price controls, and inflation. I basically said that this is exactly what they were going to do. And the exact quote was, the United States is experiencing nearly 7% inflation, and we see our politicians calling out various industries from beef producers to grocery stores in regards to alleged price gouging. If history serves as a guide, it is unlikely that the corporations are actually price gouging. It's much more likely that their labor and material costs have drastically increased. And then I basically started to talk about Turkey, and I think I talked about Argentina in here, if I remember as well. But what I basically said is if you're going to continue to accuse grocery stores of price gouging, including things like Kroger with a 3% profit margin, all of a sudden we may be talking about some issues. And so instead, what we need to do is we need to prevent against this. And my whole idea was you better be very careful because the price controls, they're going to try to implement them in the United States.
They destroy the productive capacity of the economy, and it makes the inflation problem way worse over the longer term. Yeah. This is how we got to the 70s. The 70s was price controls and unionized labor. We don't have as much unionized labor anymore, but I think we have a form of unionized labor in the sense that the total number of job openings right now is 1.7 times the total number of unemployed workers, which means workers right now have as much bargaining power as they ever had, which is effectively a union, right? They're not unionized, but in terms of worker bargaining power for wages, it's as high as it's ever been. You're seeing, the turnover in jobs is as high as it's been. The quits rate right now in terms of private sector quits rates at 3.2%. That's 20 basis points off an all-time high. So people are actively moving jobs looking for higher wages at a rate that's never been seen before. So it feels like we have unionized labor. And obviously, if we do anything that looks like price controls, this thing's going to get way, way, way worse. And the problem with this situation is that there's smart people in a room like ours, and there's plenty of smart people in plenty of rooms across the country and across the world that can see this slow motion train wreck. But the problem is they're not communicating, or they don't have avenues to communicate to these buffoons like AOC and Senator Warren. And I mean buffoons because this is ridiculous.
They don't understand economics. It's okay. Where can people go to 42 Macro? 42macro.com.
Go check us out. I'm at 42 Macro DDL on Twitter. We got Bitcoin conference next weekend, so come down here, have some drinks with us. Let's have some fun. Yeah, man. I'll see you guys next week.
Thank you so much. We appreciate it. Thanks so much for listening to today's episode. I really hope you guys enjoyed this one. Make sure you subscribe.